I'm going to talk a lot about changing market structure. So while I run a discretionary macro strategy, and I'm not trying to raise money, I'm not trying to meet allocators, I'm doing this because I'm trying to put it out there and make sure that people are aware of what I think is happening. And if you disagree, or if you've seen something that says something else, feel free. I would love to hear the pushbacks. Two things are infinite: the universe and human stupidity. And I'm not sure about the universe. So said Albert Einstein. Except he didn't really say that. It's attributed to him. The point that I'm going to make is that we do really stupid things all the time, and we think that they're really, really smart. February 5th, 2018, equity volatility exploded and took down a $2 billion ETN. Right, so this is the XIV. As you can now see, it has been liquidated. This was the target manager trade of 2017, and if you remember the Wall Street Journal, this was up 650%. People were making millions and millions of dollars. It was $2 billion in total assets. There were affiliated ETFs. There was a product called the SVXY that was identical in structure. It was inverse to the VIX measure of volatility, performed in a very similar fashion, and interestingly enough, there were options that had been issued against this. Those options were fantastically mispriced for a very simple reason. If you actually understood this product, what you understood was that the higher it went in price, the higher the probability it would go to zero. The options were priced as Black-Scholes. Okay, so understanding that structure created the potential to trade around this and to be very long volatility and make a lot of money without taking the negative carry associated with it. What was amazing about 2017 was that while the index vol was falling, right, which is the yellow line, single stock vol had actually been rising for the entire time period. For those of you that know how index volatility is calculated, what that's telling you is that the unique story in 2017 was the epic collapse in correlation that occurred basically after Brexit in 2016. It was just a monotonic decline. And you can look at this and you say, well, yeah, but that kind of makes sense. I mean, we were coming off of the elevated levels of volatility in late 2015, early 2016 with the Chinese devaluation and the concerns about Asia. We're also coming off the levels of volatility that had been experienced in 2011 and 2012 in the euro crisis, and the even higher levels of volatility and correlation that had occurred in 2008. Well, it's not entirely true. Correlation actually hit its local peak in 2011 and 2012 with the flash crash. But in general, we have this pattern of declining correlation. This makes sense, right? One of the things that's so fascinating here is that this is the entire data set that's available on correlation in Bloomberg. It goes back to 2011. Correlation is from a calculation standpoint, it's intensive. The longest data sets that you're going to see on correlation will typically go back to about 2005. And it requires, if you're thinking about the S&P, a 500 by 500 matrix showing the return of each individual security. You have to draw a relationship between the two. How explanatory are the returns of each individual component, right? However, you can take this back over time. So this is the exact same data series I just showed you. And this is a mathematical construct that I call co-movement, that as you can see is functionally identical and does a very simple thing. All it asks is, did they move in the same direction? Right? So if two stocks advance with each other on a continuous basis, forget the amplitude, then it is highly likely that they are correlated in terms of their behavior. Right? And we can actually use that insight, it's called Kendall's tau, to extend back this data series pretty much as far as we want, right? And so what we see is actually since the mid-1990s, the underlying trend in correlation has been one that has been rising. And instead of being somewhat in line with the trend, the period around February 2018 was extraordinarily extended relative to the trend. So it became even easier to predict that something like this was going to occur. Why was there this disconnect? And I apologize, I'm going to try to talk to both sides of the room. Why was there this disconnect? Well, it's important to understand what correlation from a statistical standpoint is actually telling you and why you can have low correlation, right? There are two reasons why correlation can be low. One is the presumption that most people make that there's no relationship, right? Correlation is just telling you how much of the movement of variable y can be explained by the movement of variable x, which creates a second explanation. You just didn't change x. All right, so we all remember our Statistics 101 course, where we're taught the relationship between crop yields and fertilizer application. Right? Fertilizer is applied in tons per acre. If we changed it by pounds per acre, then other variables would dominate. Right? The amount of waterfall, the amount of sun, and fertilizer would appear to have no impact on crop yields. That would obviously be a false assumption. I will tell you a crazy story from my prior career, even before I started managing money. I used to work with General Motors and their service parts operations. And when they were rebuilding their warehousing software in the late 1980s, early 1990s, they were looking for ability to reduce the computational intensity. Right? And so these are warehouses, and they said, okay, what is information that we can reduce in terms of the variables? Well, the height of the product, the width of the product, the depth of the product, that just gives us the volume of the product. And so we can actually discard the height, width, and depth components in terms of each individual product. What that suddenly meant was that the volume of an engine block, which is a square, was roughly the same as a bumper. And they started trying to put them into the same bins, right? Complete disaster. This is very similar where what's actually happened behind door number 2 was the winner. What occurred in 2017, right? So this is actually looking at the number of days or the fraction of days where the S&P moves by a certain percentage, between 0 and 25 basis points, 25 to 50, 50 to 100, 100 and more. And what you saw in 2017 was that the fraction of days in which X, the S&P, moved was by less than 25 basis points was the highest in history. And so that low correlation was a product of there not actually being any movement in a variable. This creates another measure that we can use. I call it conditional correlation. And this is looking at the co-movement of the S&P 500 on days where the S&P moves less than 25 basis points. Guess what? It's basically 0. What happens if we look to 25 to 50? Uh-oh, it's rising. 50 to 100. 100 to 250. I don't go higher than that because the days are so infrequent and the impact is quite different. But suddenly what was a very low level of correlation becomes a very firmly defined trend. And why is this happening? Why are we seeing this big trend increase in correlation? What are the implications of it? First, let's ask why they weren't moving. So the reason they weren't moving is because of systematic volatility selling. Right? When you engage in a strategy or you invest in a strategy that involves something like a call overwriting, right, or an iron condor, or an accelerated share repurchase from a corporation where they are synthetically selling puts on their own stock to the street, it leaves Goldman Sachs and other market makers in a position where they are what's called long gamma, long theta. It's effectively like being short a straddle, right? And that's exactly what we saw if we looked at the market as of December 17th, 2017. Right? There was an underlying position where the market was currently in a position where you were short a straddle. Okay, now, we have all done something like being short a straddle. We're going to try and play a video here, and I apologize if we run into any challenges. But traditionally, this was done by human beings. You delta hedge. You move your underlying futures position back and forth, changing the position of your portfolio to reflect the increase or decrease in delta of the option, the short option position that you have. So this is actually an experiment that was done at Carnegie Mellon University, and this is showing a human being managing on a delta basis, a 2-axis movement. There's a sled, and she's trying to manage an inverted pendulum, right? Trying to keep it up. So why don't we play the video? And she's good at it, right? Oh, so there's some movement. The market had some disruption. She starts to go back and forth. Now, this is a little bit boring. Human beings have a tendency to forecast. They tend to overreact, right? It becomes increasingly wild. And eventually she reaches the edge and it tips over. Let's advance to the next slide. This is what it looks like when an algorithm does it. And just to make this more fun, instead of a single pendulum, this is a triple jointed pendulum. All right? A triple jointed pendulum, it is impossible for a human being to do anything like this. Can we start this video? And this is, I believe, happening at MIT. Okay, now the video is still going. It just stopped. This is what was happening. Algorithmic management of short volatility positions. Continuously delta hedging in small fractions. Right? Now, that sounds great. What's wrong with this? Well, the problem is that this became the dominant feature in the market. Right? And it continues to be today. We're seeing it right now. We are back to this positioning where the short vol positions in the market are the highest they've ever been in history. Right? And so we're seeing this incredible decrease in the fraction of days in which the markets are moving, but underlying it is this embedded correlation so that when the market does move, it can explode. Right? As I said, we can actually extend co-movement back over time, and we can start to see a bigger underlying trend. Right? This is not a period of low correlation. As a matter of fact, and this has the more recent data on it, this is the period of highest correlation we've ever seen. Why do I think this was? Well, there's the Registered Investment Advisor Act of 1940. Right? Basically placed limitations on leverage that could be used by those who were managing public securities. Something else happened that almost nobody knows about. In 1996, Vanguard discovered futures. Why did they do this? They did it for a perfectly benign reason. The inflows coming into index funds were high enough that they were beginning to develop tracking error. They couldn't efficiently replicate the S&P 500 or other indices as new money was coming in without influencing the illiquid securities. They again went to the bright backroom boys at the various Wall Street banks and said, what can we do about this? And they were told, well, why don't you just buy futures? Well, we can't, because the Registered Investment Advisor Act of 1940 prevents us from establishing margin accounts. You need a margin account to trade futures. And the SEC said, that's fine, go ahead. I believe that this is actually what kicked off the dot-com bubble and the period of irrational exuberance. Because there was another flaw at that point. Right? In 1996, the structure of indices was that they were market cap weighted. And you're going to say, hey, wait a second, they're still market cap weighted. No, they're not. They're float weighted. And the unique feature of the late 1990s market was that you had large cap, low float companies like Microsoft. And so Vanguard was trying to buy Microsoft in proportion to its market cap, putting $2 into Microsoft relative to every available share. And guess what happens when the dominant flow is trying to buy twice as much of something? The price goes up. Who are the people who are naturally overweight Microsoft? The geniuses who were assigned to manage a tech fund coming out of Harvard Business School. They had no affinity for tech other than the fact that the fund that they ran was called a tech fund. Right? So they were overweight Microsoft, which meant that their performance was great, which meant that they attracted additional capital. What did they do with that? Did they go buy cheap home builders or trucking companies? No, they bought tech companies. And Wall Street met their need to buy this stuff by producing IPOs. Right? They bought those IPOs in the exact same way that in 2006 they would have created a synthetic mortgage for your demand for mortgage products. February 2018, co-movement, on February 5th, 2018, co-movement, the number of stocks in the S&P moving in the same direction hit 100%. First time in history. That's not the best part. It happened twice in December. I genuinely believe that what's actually happening is that the influx of money into passive vehicles is driving this. And it is being exacerbated by the dynamics of systematic volatility selling. So when, as an allocator, you say, you know what, I'm just going to buy cheap beta. I don't see a reason to hire an active manager. What are you actually doing? You're hiring an algorithm that is the world's simplest. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. No discretion, no value, no cash on the balance sheet. It's just a pure pass-through of your instruction that you may not even realize you're giving. Okay, this now brings up another component. Why have markets historically functioned as discounting mechanisms? So this is proprietary research that I did at Teal Macro. We did a survey of roughly 450 investors. We presented them with a question. You're a portfolio manager with 5% cash in your portfolio, removing a cash constraint. You receive a 1% new inflow or outflow. What is your propensity to use that cash to either buy new securities or to hold it as additional cash, contingent on valuation? And what you see, unfortunately, I'm not sure if I can get a arrow pointing this. What you see is what you would expect. The yellow line, which is the propensity to sell, rises as valuations get higher and falls as valuations get lower. The gray line, which is the propensity to buy, is very high at low valuations and low at high valuations. And interestingly enough, the intersection between these two that occurs, and this is totally random in terms of the survey construction, et cetera, at roughly 50%, is exactly the historical PE of the market at 16.5 times. Right, so what's actually happening in the market is that markets discount because the participants discount. And we can actually see this. So this is an agent-based model that we built to run through a simulation of what happens when inflows and outflows come in. And on the left-hand side, you can see the resulting PE. Now this rises over time because we're showing net inflows and also because we're keeping earnings constant. But effectively, PEs become mean reverting in response to inflows or outflows in the market. I didn't ask a question about interest rates, by the way. I didn't ask any of that. I didn't say, what are the companies? What's the quality of the companies? What's their return on equity? Right? This is embedded in the market. This is telling you that valuation is an endogenous feature of the structure of the market when it was constructed of discretionary active managers. When you introduce passive, again, remember, passive is the world's simplest algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. So their propensity to buy or sell is 100% based on flows. And so the implications of this is that you shift the market. You move in terms of propensity to sell from the yellow line to the orange line. I should do a better choice on color selection here, I apologize. In terms of the propensity to buy, you've also increased it, right? And so you've changed it from give or take 50% at 16.5 times to roughly 80%, right? Now, this doesn't actually seem like a big deal initially, but if you run the same simulation, what you discover is that the initial impact of passive is quite small, right? The market seems somewhat indistinguishable. You get a higher valuation than you've ever seen before as you go through the early stages of this, and then you get a more dramatic decline in PEs than you would have seen historically. Gosh, that seems an awful lot like what happened in the 2000 period, right? But then once you begin to approach 50%, the system becomes totally unstable. There's nobody to sell to you, right? And PEs can go infinite. That's on inflows. On outflows, the solution set is the market goes to zero. Right? There's literally nobody to buy from you. This is a deep misunderstanding of the role of active management. The current mantra propagated by Bogle and others is the idea that active managers are paid to value securities. Right? You're not paid to value securities as an active manager. You value securities so that you're prepared to provide liquidity. If somebody wants to buy Apple from me at an absolutely crazy price, I'm willing to sell my shares of Apple because I've done valuation work that suggests they're paying too much for it. If they're willing to pay way too much for it, I'm going to synthetically create Apple shares by shorting them, right? That allows me to sell it to somebody even though I don't have the shares. So I synthetically meet that demand when it begins to run wild. On the other side of the equation, if all hell is breaking loose and everybody wants to sell, I'm prepared because I've done my valuation work to provide liquidity. I'm willing to step in and give you my cash in exchange for your securities. In order for the market to work efficiently, the active managers have to be large enough that in aggregate they can supply liquidity on those events. And so the idea that we should be thinking about how much do we pay active managers so that they can be compensated for constructing DCFs, right? And that we can think about, let's lower active management fees to the point where they basically can survive and there's a few participants. That's wrong. It's just wrong. If we get to 90% passive, as John Bogle and others have speculated we can get to, that means 10% of the market is going to be providing all the liquidity. Think how much cash that 10% has to carry in order to fulfill those liquidity provisions. It also has a really perverse impact, and this is a little bit mind-bending, but the current mantra in the market is the problem with active management is there's too many active managers. They're competing away the profits. Bill Sharp's conservation of alpha, they charge fees in excess of passive. In aggregate, their returns have to be the exact same as passive, and therefore, they're going to offer negative returns. This is actually something very different is happening. If my work is right, what it's actually suggesting is that there's curvature in the return space. If time becomes positively correlated with passive penetration and the features that I'm talking about, what it creates is an upward curving, a positively convex surface. Alpha is a linear equation solution. It's the B in a y equals mx plus b equation, right? And again, initially, if we look at time 0, where there's no passive penetration, your intercept is going to be against a horizontal line. The historical returns are going to look just like the forward returns. That's your hypothesis. And therefore, the alpha that is created is value that is created by the active managers. But if you create a positively convex surface, over time, that intercept is going to be forced lower and lower. There's another feature that very few people realize when you look at this chart, which is that your beta calculation is also incorrect, right? Because the beta is the instantaneous solution, the derivative, the first derivative of this curve, not the slope of that linear line. Right, so what is happening is that the beta of the market relative to its own history has increased dramatically. There's empirical evidence that supports this. This is the simplest form of looking at a hedge fund-like return, right? So what I'm looking at here is the rolling 5-year annualized alpha for call overwriting strategies, buy-write strategies, right? Very similar to the return profile. We have a very short history of the HFRI indices and their current incarnations. You can see the red line down there. This has been almost a monotonic decline. Right? And nobody thinks to look at buy-write strategies and say, what's the alpha associated with them? Because this is crazy to think about it this way, right? You own the underlying security and you're selling optionality. That has to deliver positive returns associated with it. You're selling options against your portfolio. That has to be positive. But for this to turn negative, what it has to tell you is that you're underpricing that beta, right? The market has now introduced shape and convexity. That means those options are all really cheap. The exact same discussion we started with when we talked about the XIV complex. We're also seeing this in terms of the behavior of individual securities. I love this chart because of the description on it, right? Earnings day moves are 3.9 times as stock moving as an average day, above the average of 2.5 times over the past 20 years. Does that look like a chart that should be described as an average over that time period? I think that's absurd. What we're seeing here is a trend of rising volatility, a rising fraction of volatility that occurs on fundamental events. Why is this happening? Please tell me who at Vanguard is paying attention to Apple's earnings report. They don't exist on that day. There's nothing in the instruction set for a passive investor that says react to Apple's earnings. As a result, roughly half the market liquidity disappears on those events, right? And you're seeing greater impact in terms of the volatility. Why is this a problem? Well, among other things, as populations age, as the baby boomers begin to hit retirement, we should see lower equity allocations. I'm going to show you another slide. This is actually from the San Francisco Fed. It's looking at the ratio of middle to old people. And it's basically saying who's buying versus who's selling, what fraction of the population is buying and selling. I don't think this is totally correct, but the underlying feature is right. We are going to see a wave of selling as the baby boomers and the pensions that were created around them begin to approach liquidation. We're seeing this in many state and defined benefit plans that they've moved into liquidation. 401ks are now moving into net liquidation. Now, that's a $14 trillion asset pool that has grown from $100 billion in 1980 and today is now turning negative in terms of its net contributions. There's more money coming out than going in. This is why you're seeing the declaration that nobody's in this market. Flows are negative, households aren't buying. Well, of course they aren't buying. They're 75, right? They're selling so they can buy cat food. The crazy part is this is going to get even more systematic. So this is actually from Vanguard. They put out a report, and again, I apologize that it's difficult to see this. The chart on the left is age-based equity allocations among Vanguard retail investors. This is a report that they put out in May of 2018, and their point was some fraction of millennials don't trust the stock market and don't buy enough, right? And so they're showing in the step function line, the dark gray line, this is the allocation that you would expect to see based on their target date formulations. Right, what they neglect to point out is that the right side of this equation, which looks at the average and median allocations for older people relative to their target date funds, is literally 100% too high. Right? 70% of the assets are held by baby boomers. So we are massively overallocated. And then there's another chart to the right that shows you an even scarier thing. Vanguard manages $1.8 trillion in corporate pension plans and external sourcing. Fidelity has a roughly $5 trillion platform doing the exact same thing. This is a point of pride for Vanguard. Roughly 53% of the assets in Vanguard 401ks, or I'm sorry, 53% of the fund holders in Vanguard 401ks have a single investment, their target date fund. 53%, and their goal is to get to 77% by 2023. Right? This is crazy. We know exactly what these people are going to buy. We know exactly what these people are going to sell. We know exactly what their end holding allocation levels are going to be before they do it. How is this an efficient market? This is bananas. December 2018, the largest equity outflows in history, 2.5 times the levels that we saw in 2008. Now, the story on the street was this is tax loss harvesting. Right? This is an efficient management. What it really was active managers being redeemed. We didn't see outflows from passive managers in any meaningful construct in the last quarter of 2018. What were we actually seeing? We were seeing the first taste of the baby boomers retiring. At the age of 70.5, you're required to take distributions from your 401k for tax purposes, to tax-deferred assets, right? We now have 3 years worth of baby boomers who are now 70.5, and they have begun to sell. This year-to-date basis, what do we hear if we look at positioning reports? Households are net sellers. Right? This is the retirement of the baby boomers. It was off in the future. It's here now. And the scary thing is that they're increasingly holding these same passive vehicles that when they give the instruction to sell, so far it's coming out of active. And active has discretion. I'll try to meet your redemptions with the cash I have available on hand. Selling the securities is my second choice because I know it adversely affects my performance. But if I send that instruction set to Vanguard, they dump. We'll conclude with another quote from Voltaire. Those who can make you believe absurdities can make you commit atrocities, right? The stories that we're told about passive are not true. Bill Sharp's conservation of alpha has assumptions behind it that are not true. Simplest one being, there's no transaction if you're passive. You don't need to buy or sell to get in and out of the market. You just happen to be there. Right? What we've seen in the period from 1996 to, I would argue, roughly 2017 was them buying. Now I'm concerned that we're going to start to see what happens when they sell. That's it. Any questions? Brian.
What we're seeing, in terms of assets is to some extent some kind of greater fool theory, right? Like I have to trade on flows because everybody else is investing on flows. It becomes difficult, right? You said, because you're not really looking at valuations and what would be the type of sector for the next 10 years. You're just trying to say, but everybody is buying this sector, so I have to buy this sector. When does that inflection point happen?
I think we're already in it.
You think we're already in it?
Yeah. If we go back to that.
So then, what other milestones are we looking for?
Well, for the theory to be correct, right, you would expect to see this sort of pattern of a somewhat linear decline in alpha. You would expect to see this pattern of the markets behaving in a manner that is more correlated, right? So stocks that seem to have no underlying economic relationship with each other begin trading together, right, because they happen to be in the S&P 500, right? We're seeing all of this. And now in the last 6 months, we've seen one of the biggest declines on record on almost no fundamental news, and one of the biggest rallies on record on no fundamental news, right? I mean, we can decide that it's wrong. I mean, I'm perfectly happy for the theory to be wrong, and I agree that it can't be proven until it occurs. In the exact same way that, buying puts on the XIV or SVXY to be more accurate, literally the street was like, what the hell are you doing? This is completely insane. All this thing does is go up. Right? But the structure is rotten, and those flows are going to come out. Right there.
So what do you think about the corporate buyback? Because we see on the retail side, people are constantly selling. Whether the market go up or go down, they are net sellers. But the huge amount of buyback. So maybe the pool is shrinking. In that sense, the price change may not be as much. What do you think about the effect of buybacks?
So I think that's absolutely right. I think that there's two impacts of buybacks. One is that, or three, to be totally fair. One is that it's currently favorable to argue that buybacks should influence valuation. That you should be thinking about the combined return of cash in the form of buybacks and dividends, and therefore that combined yield is quite high. Theoretically, that's totally flawed. Right? Because dividends are actually very different. They're a distribution to all shareholders. Buybacks are a distribution to a favored few, those who are selling their shares. Cynically, I would argue those are primarily corporate insiders, right? Because what you've largely done in many of these companies is offset the float increase that's been created by grants to management. But on a less cynical basis, it's viewed as a tax-efficient way to return cash to investors, right? What it's really doing is it's influencing the market in terms of there is a ready and willing buyer to take those securities from you as you attempt to sell, right? And that's great for management pay packages, by the way, right? But it is a return of cash. The real concern is twofold. One is that the structure of these buybacks are increasingly taking on a form, whether it's in the form of accelerated share repurchase programs or in the form of automated 10b5-1 plans where the instructions are set up so that they behave as synthetic puts. Right? It's very common for a 10b5-1 plan to have language that says something along the lines of, if the stock falls below its 200-day moving average, accelerate the purchases. Right? Well, if I have to outlay cash when prices fall, I'm short a put. And that's a supply of synthetic volatility. And so if you go to Goldman Sachs, and I don't mean to pick on Goldman Sachs, they're just ubiquitous. If I go to Goldman Sachs, and we all like to pick on Goldman Sachs too, but if I go to them and I say, I'm going to have a corporate share buyback program, what they actually do is they treat that as if you have sold them a synthetic put. And then they realize that because they're running a diversified platform of corporate share buybacks, they've spread so much, that actually gives them an inventory of vol that they can go out and sell index vol. Right? And so this is exactly what's happening. This is the supply of vol that is actually occurring into the market. A sizable fraction of it's coming from the corporate share buybacks. What we need to be really concerned is eventually those are going to stop. We will encounter a cyclical event in which corporate profitability deteriorates, or a credit event in which many companies are unable to buy back their shares. Excuse me. And when that occurs, we're going to discover that this was a very pro-cyclical phenomenon. I think it exacerbates the underlying dynamics. There are a couple of questions. Kieran wants to hassle me over here.
Hey, Mike. CEO of BlackRock said the world, just recently, world's awash in cash. U.S. is 2.5% rates with a pretty decent currency. And this next biggest market in the world is China, where you have a lot of restrictions on buying and selling. And I mean, it seems like, how do you make sure that this 401k data matters? Because money keeps flooding here from all over the world, and it doesn't feel like it's abating. It doesn't feel like money's coming out of the market, does it? You tell me.
Well, so there is net money coming out of the market. We actually do know that for a fact. The question is, how do we think about what is the dominant flow components, right? As it relates to the S&P 500, the dominant flow component right now is absolutely corporate share buybacks. That is by far the largest share component. This year, it looks like it's going to be somewhere in the neighborhood of $900 billion in terms of corporate share buybacks, and talked about that a little bit. In terms of money coming in from other areas around the world, on net, they're actually now selling from US securities. So I'm a little bit less focused on that dynamic. 401ks, as I indicated, are selling. Pensions in aggregate are rebalancing away, with one other interesting feature. Because of the Fed's reaction function, we've introduced the idea that you can own bonds and own stocks, and the bonds will hedge your equity position, right? This has created another synthetic instrument, which is that there's an embedded put in the ownership of treasury bonds, right? When you have a positive return vehicle like a treasury bond that has a hedging feature associated with it, you now have a positive expected return put, and your calculus changes in terms of your portfolio construction. Instead of owning 40% bonds, 60% equities, you own 100% bonds and 100% equities. You run a levered portfolio on a modern portfolio theory construction, right? That's been an additional source of buying power. And so I don't dispute that all of these factors have conspired to drive this type of dynamic. What I'm most concerned about is that that leverage has actually taken the form primarily of just buying beta, buying the S&P 500, right? And has done so through either total return swaps or index constructions or futures, right? So we're all piling into the same thing. It's actually an aggravation of the underlying feature. Yep. Yeah, you're at fault. This is BlackRock, by the way.
This is BlackRock. No, I wasn't sleeping. I
Yeah.
passed out because I thought it was an interesting fact that I read on the plane, also from Larry Fink. Is this on? But he's saying, they're estimating 10,000 baby boomers retire every single day, starting now, for the next 10 years.
Yep.
How does that impact?
So those,
U.S. equities,
Yeah.
fixed income, based on asset allocation.
Right. So the quick answer is we don't know exactly, right? If I flip back to this slide, one of the things you'll notice is that baby boomers and older people have held more equities than we would expect them otherwise to hold, right? I actually think this is, I think one of the things that worries me most is that the institutionalization of quote unquote professional asset allocation is going to encourage them to sell more than they otherwise might sell, right? So a target date fund is going to lead to net reductions in equities relative to what we would otherwise have seen, right? There's a variety of reasons why that is, mostly inattention, right? You can also argue that there's a sizable fixed income allocation associated with things like Social Security that is not typically captured in the analysis, right? So in general, if you're thinking about your own personal retirement, you're using a target date fund, remember that it's not capturing the other fixed income components of your life, whether that's a pension or Social Security. If we begin to behave similar to target date funds, right, it would suggest that as those baby boomers retire, the quantity of net selling from the household sector is going to begin to rise precipitously. Last year, it was about $100 billion in net redemptions that came out. Some inflows at the start of the year, lots of outflows at the end of the year. On year-to-date basis, we are negative, somewhere around $80 billion in terms of household selling. I would expect that this year that rises to somewhere around $250 billion in total. If you believe the demographic dynamics and they start managing in a more aggressive fashion, and again, the penetration of these target date funds rises, so each retiring cohort has higher penetration of these types of strategies, the numbers exceed $1 trillion by the time we get to 2023. Right? And at that point, even if we're buying back $800 to $900 billion in shares, we're talking about net redemptions.
So right now it's a positive.
Right now it's net positive because of the corporate share buybacks.
Just one question. You said this is net fully made stock.
In the household sector,
Just
yes. Let me rephrase that. The household and actually the foreign sector as well. But
net is always the same.
I'm sorry, what?
Net is always the same amount of money at once.
No, that is absolutely not true.
If I sell my stocks, I buy something's price.
What if you, so let's pretend we own stock A, right? It's currently priced at $100, right? You sell it to me at $100, I agree with you. You try to sell it and there's nobody to buy it from. I say, you know what, I'll bid 70. Is there the same amount of money in the stock market?
No, but if the stock market,
That's the answer. No.
but the stock market hasn't come down.
No, it's done the opposite for the reasons that I'm talking about. It's gone the other way. The convexity in the positive direction has raised the amount of money in the stock market relative to what we would expect under normal conditions. Yeah.
I just thought, I just wanted to ask you a little bit more about December.
Yeah.
Because we definitely got a lot of questions about December.
Yep.
And
Apologize, I
from,
just want to go
and from what I've understood from your discussion, December was sort of the tip of the iceberg in the sense of some sort of sense of us starting to see this type of behavior occurring. How can you explain what's happened post then? Sort of, would that be sort of reinforcement of passive rebuying, sort of regaining its strength after?
Yeah.
And that's why the market's been going up so much since the beginning of the year? Or what's your thoughts on that?
So some people have talked about some of the dynamics, right? I describe it as there's two different types of flows. There's endogenous flows and there's exogenous flows. Exogenous flows are money coming in and out of the market, right? Endogenous flows are risk-taking within the market. And what we saw in the fourth quarter was a combination of outflows, particularly from active managers, that by and large just exceeded their expectations. And as a result, they were forced to endogenously within their portfolios de-risk, right? Which created both exogenous and endogenous negative flows. And so the market sold off quite sharply. Post December 24th, 27th, right? What you've actually seen has been a significant re-risking within the market. And so others will track this quite well. Nomura does a good job of it. Goldman does a reasonable job of it. There's independent parties. You can subscribe to their research. They'll track the behavior of things like CTA flows. And so what we've seen is we've seen a net re-risking within things like the CTA space of almost $600 billion off of the December lows. And that's occurring in the context of what they buy are futures, right? They're buying the Russell futures or the S&P futures or any number of other things that behave exactly like these index vehicles. And so it's happened in the context of very decreased liquidity, and at the same time, corporate share buybacks have been off the charts. Right? So I would argue the increased volatility that we're seeing around this is indicative of the features that I'm talking about. But yes, unfortunately, I think the fourth quarter was the opening. It was a warning shot. Isn't it great to start off morning this way?
Bad things are going to happen.
Yeah.
I mean, so it would seem that the implication is that for a lot of strategies, for a lot of managers, they used to be playing a valuation game, but now markets are a flows
Correct.
game. Is that fair to say?
Yes, I think that's absolutely correct.
presentation, why didn't you address interest rates, the Fed, and some of the behavior of the stock market in December and year to date?
So that's an entirely different presentation. Long story short, interest rates, if you correctly define what equities are, right? So equities are a long call position, a short put position, a dividend receiving position, and a secured rate position, right? If you think about the two halves of that, the call minus the put, right? The interest rate relationship there is actually negative. The higher interest rates go, the more valuable that portion becomes because the put has declined in value, the call has risen in value, the delta between the two goes up. We're used to thinking about the right-hand side of the equation, which is the discounting of the dividends, right? And so that goes down in a higher interest rate environment. The reason why I don't specify interest rates is because it doesn't actually matter. The relationship with interest rates and equity prices, particularly risk-free rates, is, I would argue, deeply misunderstood, and we see this in the market. They don't behave on the basis of interest rates. If anything, they actually trade in the opposite direction of interest rates that you would expect on a discounting basis for the past 20 years. I think people underappreciate the fact that the only time interest rates become super relevant is if they get high enough that people say, screw it, there's no reason I'm going to take any form of equity risk. It's a substitute asset as compared to a complementary asset. So that's why I didn't address. I don't think in this range interest rates matter at all. Anybody else?
Okay, thank you very much, Michael.
Thank you.